And I'm just going to start our recording and say hello. So good morning, afternoon, or evening, depending on what time zone you're calling in from. Thank you so much for joining us for today's webinar, where we're going to learn about going beyond environmental, social, and governance, or ESG considerations, all the way to impact investing and advancing the Sustainable Development Goals, or SDGs. We'll try and be clear on our acronyms throughout the hour. So to do that, we'll be getting an in-depth look at the new operating principles for impact management released recently by the IFC. And so my name is Hannah Bowen, and I'm the network manager here at the Intentional Endowments Network, or IEN. And so happy to be moderating today's webinar and to be joined by Neil Gregory. Neil is the Chief Thought Leadership Officer at the International Finance Corporation of the World Bank Group. And he'll be sharing with us some of the evolution of impact investing and some more specifics on how to measure and manage for impact. And then we will turn to all of your questions. So a few logistics up front. All of the participants in the webinar are muted, but you can ask questions or add comments or observations, your experiences at any time. So you can use the Q&A function of this Zoom platform or use the chat box, and I'll be monitoring those throughout the webinar. And I can see that the raise hand feature is also being used. So we'll try and get to those questions if you can add them again in the chat box or in the Q&A box. The first question already up is the logistics one, which is, will this meeting be recorded? Yes, we are recording, and I'll be sending this recording out tomorrow, and it will be posted on the IEN website along with previous webinars that we've done. This is a monthly-ish series on sustainable investing and everything happening in the world of ESG, impact, responsible investing, socially responsible investing, and we'll get into all of those terms. We have a long series of webinars that you can refer to there, and you'll be getting the recording after the fact. So I think those are the key logistics. Keep an eye out tomorrow for a follow-up email. And before I hand over to Neil and dig into the main topic for today, just want to give a very high-level overview of the Intentional Endowments Network for anyone who might be new to our network and our work. So we are a nonprofit, collaborative, peer learning network where endowments and experts like you'll hear from today come together to really advance the field of aligning their investments with institutional mission and sustainability and performance goals, and very much believe that you can do all of those things at once. So we do this in a variety of ways. We have in-person forums and events. We facilitate peer networking. We curate resources on sustainable investing opportunities and kind of what's new in the field. And we have educational tools like this webinar. And you can become a network member as an asset owner, an endowment, an asset manager, another stakeholder in this field to keep growing this movement. Or you can join us for specific programming that's open to non-members like this webinar. For those who are looking to unmute yourselves, it is in webinar mode, in presenting mode. So all of the attendees are muted, but you can use that chat function and the Q&A function to add comments as we go. One more slide here on the Intentional Endowments Roadmap. This is a tool that we've developed to help explain sort of the pathway that endowments, investors go on in this journey to align their investments with their institutional mission and goals. This is one of the many tools that's on our website. You can see that at the bottom of the screen. And please feel free to share additional resources that we can share out to the group. We want to keep this conversation alive. It's an iterative process to learn and grow together. So with that, I will hand it over to Neil, who will walk us through this presentation. And then again, we'll have 15 or 20 minutes at the end to go through questions that you shared in advance. Thank you very much for sharing your questions in advance for us to prepare and to get to at the end here. And then any new questions that come up throughout the presentation, we'll get to then. So with that, I will hand it over to Neil. Welcome.
Thank you, Hannah, and hello to everybody. Very glad to have the opportunity to talk to you today. This is Neil Gregory. I'm based in Washington, D.C. with International Finance Corporation, and we consider ourselves to be one of the original impact investors, having been in business for over 60 years, investing both for impact and for financial returns. And so we've followed the growth of the impact investing market with interest, and increasingly have got engaged in helping to shape and clarify what it means to be an impact investor, and that's what we're going to talk about today. So first, a little bit about IFC. Next. So we are part of the World Bank Group, which means that we're a multi-country organization owned by all the different countries that are shareholders of the World Bank Group. We are operationally independent. We have our own balance sheet, and we invest both in terms of debt and equity into firms operating in emerging markets in lower middle income countries. As well as investing for our own accounts, we also mobilize capital from banks and pension funds and insurance companies and the like. So each year we invest about $11 billion of our own money and about $11 billion of money from our co-investors. That gives us a total portfolio of assets under management of about $57 billion. And we do this with about 3,000 staff, and we have an extensive network of field offices in the countries in which we operate. Next. So first, let me tell you a little bit about how we see the evolution of impact investing over the past decade since the term came into use. Next. Then let's start with a definition, and I can already see from the questions that we have online that this is where there's still a lot of confusion between what is responsible investing and what is ESG investing and what is impact investing. And there are different definitions out there. We looked at the definitions that are used by the GIN and by the impact management projects and so on. And this is the definition that we use, which I think is closely aligned with those other definitions. And so there are really three key words that are underlined here which differentiate impact investing from other forms of sustainable and responsible investing. The first key word is intent. To be an impact investor means more than that your investments happen to have impact. It means that you actually manage your investment process with the objective to have impact as well as financial returns. Second key word is contribute. So again, it's not enough to have investments in companies which are having an impact. To be an impact investor, you need to identify how your actions as an investor contribute to that company achieving impact. So it's more than just thematic investing, buying shares in impactful companies. There has to be some theory, some process by which your act of investing makes a difference to the impact that can be achieved. And the third key word is measurable. So again, there's a lot of concern about greenwashing and impact washing. And so it's really critical to actually be able to measure and report on social and environmental impacts with the same discipline that you measure and report on financial returns. Next. So what we see then for an impact investor is a process by which you start with an intent to have some impacts on social and environmental outcomes, which leads you to make a contribution to companies, which might be in the form of capital at different rates of return, but it doesn't depend on whether you're earning market returns or lower returns. Either way, you can still be an impact investor. And or you may provide other forms of support to the company, knowledge transfer, or you may take a controlling position if you're a private equity investor. There are different ways you can influence the underlying company to have a contribution to its achievement of impact. And then that leads to impact, which can be in terms of the specific outputs at the level of the individual firm, or in the case of larger institutions like IFC, we also aspire to shape impacts the level of market outcomes, with the aim of achieving the social and environmental objectives that you've set out in your intent. So this differentiates impact investing from other forms of sustainable and responsible investing, in particular ESG investing, which has become very largely mainstream now. You see the very large number of investors who have signed up to the UN Principles of Responsible Investing. And you can think of that as really being about making sure that you do no harm in environmental and social dimensions as an investor. And for some ESG investors, actually going beyond that and recognizing that good management of environmental, social, and governance aspects of your investments can actually contribute to good. But you're still not selecting your assets with an objective to achieve impact. It's more that having selected your assets, you then manage that portfolio to manage the ESG risks and perhaps also achieve positive ESG outcomes. So again, coming back to the definition, really this intent is a key differentiator between responsible investing and impact investing. So now in this next slide, let's look at what's been happening in the market and why impact investing has become such a hot term that everybody is now talking about. Next. So what we see is that driven by global discussions on where the world needs to go in terms of achieving the Sustainable Development Goals and tackling climate change and other social and environmental outcomes that investors care about, we see that demand from investors for assets which actually produce measurable impact has been increasing as that demand has fed through into the market. So you see the financial services industry recognizing this and responding by bringing new funds and new products to market with a SDG label or sustainable label or an impact label. And so we see this as very much a demand-driven process. But what has happened in the process is that there's a lot of confusion about what these labels actually mean. Next. Next. So to illustrate this, this chart just shows the rapid increase in the number of funds which have been launched using the impact label. And so what a lot of investors are asking is, well, what do these funds actually deliver that's different from other funds? Is the impact label just a marketing device, or is there something actually different about the way they operate? This is something we'll come back to later in the presentation in terms of discussing the principles that we've elaborated which explain that. Next. So let's take a look at how big the market is today, and we're going to break this down into a few different boxes. So the first one you see is the box that people mostly think of when you talk about impact investing. This is the specialist funds that are mostly investing in private equity, somewhat in private debt as well. They attract a lot of attention, but you can see from this number they're actually a pretty small part of overall capital markets. Keep in mind, for context, that the total amount of global assets is something like $240 trillion. So put in a market context like that, $70 billion being managed by these impact investment funds is actually very small. But what we see is that is only actually part of the larger market of assets that are being managed for impact. Next. There's also a lot of funds in public markets which also have an impact objective. Some of that is being pursued through investments in green and social bonds with the aim to direct investments to those specific ends. And that has been a rapidly growing market in recent years. And now we see it's nearly $500 billion of assets outstanding in green and social bonds. And then there's a piece of the public markets where investors actually actively manage their investments to achieve certain goals. Some of those goals may just be financial goals, but other times activist investors may be seeking to produce social and environmental objectives in the companies that they invest in. So that's a much bigger market. You can see in total over $8 trillion, and we don't actually know today how much of that is being managed for impact, but we just put it there to show the potential that that is a part of the public market, which potentially, depending on the objectives of those investors, can have a direct impact and make a contribution along the lines of our impact definition. Next. And then there's a third category of investors for impact, which until recently people maybe didn't label as impact investors. When you look at what they actually do, you see that they share the same characteristics that we outlined in the definition. So you have 25 development finance institutions which have signed on to follow common standards for measuring impact. That's what HIPSO stands for. It's a shared approach to measuring the impact of their investments in private firms. And those 25 development finance institutions manage about $750 billion in assets. And then beyond that group, there are many more national and regional development banks which have some kind of a social or environmental mandate alongside financial targets. And they are a bigger group. Again, they have about $3 trillion in their portfolios, which they are managing to achieve their social goals as well as financial returns. So again, we don't really know as of today how much of that $3 trillion really fits all of our definition of investing for impact, but we put it out there to suggest that these are potentially an important part of the market. Next. So when we look at that together, we can still see that these numbers are still very small in relation to the over $200 trillion of total assets in the capital markets. So the question is whether this is a style of investing which has room to grow. And so we've been taking a look at that with a report we published earlier this year called Creating Impact. We did some estimation of how big the investor demand might grow, looking at investor preferences for socially responsible investments today, based on whether they also were seeking market level rates of return or would accept a lower rate of return. Next. And so what we see is that there is actually a very substantial potential demand from investors for assets with impact. The bigger part of that demand is in the public markets, which is the right-hand side of the chart. And so that's a bit different from where most of the impact investing is happening today in private markets. But even in private markets, you can see potential demand of over $5 trillion as well in excess of what is being invested today. The amount which investors would like to invest clearly is much lower if they can't earn commercial returns. So while there is clearly substantial appetite for impact investments even at lower returns, the really big potential is if you can offer investments which both offer competitive returns comparable with other assets and can offer clearly measured impact. Next. So what will it take for impact investing to continue to mature and scale up to tap into that very large investor demand? Firstly, it follows from those numbers I just showed you that there will be much bigger demand if we can establish that impact investments can offer comparable returns to other commercial investments. And we did some analysis on our own investment portfolio, which I'll show you in a minute, which suggests that it is possible to earn comparable returns. Secondly, I mentioned earlier this confusion about what differentiates impact from other types of investing, and whether all these funds labeled impact are really doing something different. So to get investors comfortable with putting more of their funds into impact vehicles, we do need transparency and discipline on how investments are managed to achieve impact. Next. And as we'll discuss in a minute, there are some regulatory barriers facing institutional investors who want to allocate assets for impact. We'll come back to that in a minute. And finally, it's important that you have credible reporting and measurement of impact. Investing in assets really only took off after advances in accounting practices, which gave credibility to investors on what the returns they could get from their investments. It's going to be the same with impact investments. It's really important to have credible data for investors to understand the impacts that they're having. Next. So turning to the first point about what do we know about the ability of impact assets to offer financial returns comparable to other assets, we went back and looked at our own investment portfolio, both on the debt side and the equity side over a long period of time, to see how our performance compared to comparable public market benchmarks. And it's an imperfect comparison because we're investing in private equity and debt, and we're comparing that to a public market benchmark, but there isn't really a good private market benchmark to use. So take this for the broad order of magnitude, but with some health warnings. Next. So what we see in broad terms is that our equity investments slightly outperformed the Morgan Stanley Emerging Markets Equity Index. So the numbers in the squares and the circles here are ratios. So a ratio of 1 means outperformance. And on our senior loan portfolio, we compared that with the JP Morgan Emerging Market Bond Index. Maybe slightly underperformed, but again, given all the approximations in this estimate, I think you can say it's broadly comparable returns. So this is over a long period from 1988 through to 2016. And so this enables us to look through the various business cycles we've seen in emerging markets. And one of the features, I think, of impact investors is that they often are more patient investors. And if you're patient, particularly in emerging markets, you often can do better despite the higher volatility in these markets. But the story is that we've been selecting these investments for impact over a long period of time and be able to manage a portfolio both of equity and debt, which has really been comparable to what we would have earned if we'd put our money into public assets in emerging markets over the same period. Now, this is just one data point for one organization, but we put it out there in the interest of encouraging others to share their performance as well. We think as we get more data and information into the market about the track record of impact investors like ourselves who've been doing it for longer, it will help to build credibility with investors that they can achieve good returns through impact strategies. Part of the challenge today is that impact investing is still such a new investment style that many impact funds don't have much of a track record to point to. And so I think it's important that investors like us with a longer track record share what we can of our track record. Next. So now let me talk a little bit about how we're helping to create clarity and discipline in the market by developing some shared principles across investors. What are the key elements of managing an investment portfolio for impact? Next. So in discussion with a wide range of impact investors, both public development finance institutions and private banks and asset managers, we identified a number of common elements which we all do in our investment processes to integrate the impact dimension alongside the financial dimension at all stages of the investment process. And so I won't talk through all of these, but let's just put them up on the screen. You can see it starts from strategic intent, goes through origination and structuring, to portfolio management, all the way to how you exit your investments if you have an equity portfolio. And so these really, at a high level, explain what it means to manage a portfolio for impact. These are all things that you wouldn't do if you weren't an impact investor. And the level of high-level principles to allow different types of institutions, different investment strategies, to implement these principles in ways that make sense in the context of their own business. But it provides a common basis on which we can recognize that all of us in the variety of ways we invest are actually taking a consistent approach to achieving impact. And then underlying the 8 principles that go through the investment cycle is this 9th principle at the bottom of the screen, which really speaks to this question of credibility, that it goes beyond just the investor saying that they're doing all these things. It requires some independent verification of the investment process to provide insurance to investors and stakeholders that the investor is actually following this process in their investment. It's not just talk or marketing hype. Next. So since we developed these principles last year, we launched them in April this year with a broad coalition of investors. There were 60 investors at the first signing event in April, including 3 asset owners, 44 asset managers, and 24 bilateral and multilateral development finance institutions. And since then, we've signed another dozen or so institutions, and there are many more in the process of considering becoming signatories. So what does it mean to sign on to these principles? It really commits signatories to 2 things. Firstly, an annual public disclosure statement in which each investor explains how in their investment process they implement the 9 principles. And secondly, this commitment to the independent verification doesn't have to be done every year, but it does have to be done on a regular basis to provide this credibility to underpin their statements. And so we think as this 70 or more institutions and funds start to publish these disclosure statements over the next year, this is going to greatly enhance the transparency of the market. Any investor or stakeholder who's interested will be able to go to the website for the impact principles, find the link to the disclosure statement, and read about how any of these investors is managing their portfolio for impact, and they can also find how the process has been independently verified. So we think this will really give a big boost to the market in terms of the credibility and transparency that investors are looking for. Next. So I mentioned earlier that the supportive regulatory environment is going to be necessary if we want more of the institutional investor money to flow into impact assets. And we do see interest from institutional investors. Increasingly, the pension funds and insurance companies that co-invest with IFC, they are interested in our impact as well as our financial performance. And so we think the appetite is there. What has been holding it back has really been questions about consistency with the fiduciary duty of these institutional investors. Next. And so we think that there are different definitions in different jurisdictions, and I think this is an area where we're seeing movement, and we'll continue to see movement as discussions continue about how narrowly or broadly to define fiduciary duty. But we think clarifying that if the beneficiaries care about impact and want their investment portfolio to achieve impact, then that should be part of the fiduciary duty of the asset manager to pursue that objective as well as the financial objective. Next slide. So finally, to come back to the point about needing to have common approaches to measuring impact, I think we're still some way away from having common accounting standards for impact, although some people are working towards that. But I think what we can hope to do is to move towards more common approaches to the metrics we use for how we measure specific impacts, and more common approaches for the system we use for evaluating the impact of individual investments. I don't think we will quickly get to one single approach, because different types of funds, different types of assets need different approaches. And what we see in the market today is really 3 broad types of approaches. Next. The first, which suits funds which have fairly clear goals to achieve impact in one dimension, is the use of targets. Maybe you have a target for the number of women with access to credit, or availability of clean water, or some very specific impact like that, then we find funds that are using targeting approaches to measure their impact can work quite well. Next. But when you have more complex impact objectives, maybe you're pursuing multiple impact objectives, then just simple targets doesn't really capture the trade-offs involved in investing. So what we do, and many other larger impact investors do, have an impact rating system which allows us to score various dimensions of impact and come up with a composite rating. And we have a system to do that called AIM, and other institutions have different systems, but they do have a lot in common. And what they allow you to do is to come up with numbers for your portfolio based on the impact contributions of your portfolio, which you can then put alongside the expected financial returns for your portfolio and start to manage a portfolio both for impact and for financial returns using metrics in both dimensions. Thanks. And then we also see some impact investors who are trying to put a dollar value on the impacts and use that as a way of measuring impact. I think notably TPG's RISE Fund has attracted attention for its methodology of monetizing impacts. And I think that works well in some sectors where you can come up with fairly good financial estimates of the value of impacts, but works less well in other areas. So these three types, I think, can all work well in different contexts. I think it's a matter of choosing one that works well for the particular fund or institution. But within each of those three broad approaches, I think there's scope for more convergence and harmonization between different investors and how they use each of those approaches. Next. Next. So I think I've taken most of my time now before we open up to questions, to just finally to mention where you can find out more. We have a lot more data and information about these different approaches to impact measurement, and about the regulatory frameworks in different countries, and about the size of the market in the report Creating Impact, which we published earlier this year, and you can find it at the URL that you see on screen. And then you can find more information about the impact principles, the process for becoming a signatory, and the list of existing signatories, and read more about the details of 9 principles at the website. The URL for that is also on the screen. So let me pause there and hand it back to Hannah, and looking forward to your questions and discussion.
Wonderful. Thanks so much, Neil, for a very informative and right on schedule presentation. So we will have plenty of time to get into questions and answers. One very quick technical question came in, which was that sizing of the current and potential market. How recent is that data? So mostly that's based on 2017 data. So that's the data that we just published this year. Great. So I think there are a couple of different categories of questions coming in. So if we can maybe just start a little bit more on the measurement side, and then get to a few questions on what this means for different stakeholders. I know we have people on the phone representing a lot of different kinds of groups, both on the asset owner side, some managers, folks who are looking for investment, kind of the spectrum. So can dig in a little bit more on that. But there were some questions that came in advance, and I see being reiterated by Simone and others on the line here now about how do you do good impact measurement? And you alluded to some of the kind of categories of, talking about targets, using more of a monetizing impact framework. But are there other examples of how investors in particular are doing those measurements in the more technical how-to way, or how is that evolving? Thanks, Hannah. So I think there's actually been quite a lot of progress in the last couple of years in terms of developing common approaches to impact measurement. When you look across the industry, I think there are two quite similar
sets of metrics which have been developed. One is the IRIS Plus set of impact metrics, which has been developed by the GIN in partnership with many others. And then amongst the development finance institutions, we have a common set of impact metrics. What I mentioned earlier, they're called HIPSO, the harmonized indicators for private sector operations. Well, unfortunate other acronym to introduce, but between these two sets of metrics, and there's actually quite a lot of similarities between them, I think investors now have a good menu of measures for most of the types of social and environmental impacts that people are interested in. So I think the next step now for investors is really to integrate that into a process for deciding which metrics to select to monitor when you're making the investments, and to make sure that you monitor and report on those metrics while the asset is in your portfolio.
Great, thanks. And I think there are a number of questions around kind of the nitty-gritty details of how you make some of those measurements, and I think some of the resources you pointed to are good places to follow up afterwards, and that may be another area to explore. Are there other resources you would point people to on areas like monetization as a way to measure impact, or other places to read up on some of the metrics that folks are using?
So I think the other good resource I mentioned is the Impact Management Project. I think they have produced a lot of very useful tools and explanations of how to think about impact measurements. And what is particularly useful about the Impact Management Project is it's both looking at impacts from the perspective of the investor, but also from the perspective of corporate reporting. I think the end game we'd all like to get to a few years from now is where corporates are systematically reporting on their impacts, and then that will provide the information that investors need to monitor and report on their investments, just the same way as you have with financial reporting today. So I think the Impact Management Project is a good place to get resources and tools for thinking about impact reporting, both at the corporate level and the investor level.
Great, thanks. And it does seem like there are new tools every day, so good to know who's tracking those and making them widely available. We had a number of questions as well in advance of the webinar, and you touched on this briefly, but if you could just say a little bit more about how the Sustainable Development Goals have provided a new kind of framework for talking about impact, and seeing some additional questions now around, can there be a more explicit link between the SDGs as a way of defining impact and this work and the operating principles? So if you could just go a little bit more into how you're thinking about the SDGs as a tool and how investors are using that framework.
Mm-hmm. Great. So I think we have seen a huge amount of interest from investors in the Sustainable Development Goals since they were launched in 2015. I think they've been very effective in challenging all kinds of stakeholders to think about the contribution that they make to achieving the Sustainable Development Goals. In two dimensions. One is that clearly there's an imperative to achieve those goals, because that would be a good outcome for the world. But secondly, I think there's also been a fair amount of research showing that investments which contribute to those goals can also be very, very profitable. A world in which we're on track to achieving the Sustainable Development Goals will have greatly better financial investment opportunities than the world which is off track. And one study by the Business and Sustainable Development Commission estimated that you could find $12 trillion of investment opportunities just by looking at 4 sectors which would be influenced by progress towards the Sustainable Development Goals. So I think investors are both seeing the sort of the moral imperative of contributing to the SDGs and their stakeholders, are demanding that, whether it's pension holders, insurance policy holders. But also I think they see the investment opportunity in getting the world onto a track towards sustainable growth, particularly in emerging markets. And so what we also see is that whereas most retail and institutional investors, they have very small amounts of exposure to emerging markets, that is clearly where the big financing gaps are for the Sustainable Development Goals. And so it is also driving, I think, more investor interest towards emerging markets. Now, having said all that, when we came to develop the impact principles, we didn't choose to specify which impacts are being managed for. And that's really because we wanted a set of principles that would be neutral with respect to what type of impact the investor is having, what type of asset class they're investing in, what their investment style is. The impact principles are about identifying a common process by which you manage investments. They're not about specifying what the impact target that you have is. Equally, they're neutral with respect to whether you're aiming to achieve high financial returns or willing to accept lower financial returns. So again, they're about defining a process as opposed to defining the targets that you would establish. But the first principle says that clearly you have to establish impact objectives alongside financial objectives of many investors. The Sustainable Development Goals and the climate change goals are the starting point for thinking about what impact objectives to target.
Great, thank you. And I know people are using the SDGs as a framework in many different ways. And so, we've seen, for example, in the higher education endowment space, some of the higher education institutions are mapping their curriculum, their activities to their SDG impact. But for the reasons that you've pointed out, finding it, a little bit slower to map their investments to SDG impact, but also now seeing more and more asset managers and companies starting to offer that and starting to provide the tools to do that alignment. So maybe we can switch gears a little bit to some of those questions coming in from different stakeholder perspectives. So we've had a couple of questions from the asset owner perspective of how are investors finding and identifying impact investing managers, opportunities? How are they fitting that into different parts of their portfolio? And similarly, have a number of questions in different forms about how asset managers are identifying companies to invest in, how they're managing that relationship. You mentioned sort of the shareholder engagement element of ESG investing or of impact investing. And so what does that look like from kind of asset owner to asset manager and from asset manager to portfolio companies and looking at that in different types of investment as well?
Thanks. So let me start with the asset owner perspective. I think the first thing to say is that impact investing is an investment style or approach. It's not an asset class. So you can pursue impact investments across different asset classes. But for most asset owners, most of their assets tend to be in liquid, publicly traded assets. Whereas the numbers I showed you earlier showed that most of the impact investing opportunities today are in private equity and debt markets. So that means that for most asset owners, where they may be starting to pick up impact assets is in what they would categorize as their alternatives, where the part of their portfolio where they maybe are willing to accept higher risk and lower liquidity and maybe go beyond developed markets into emerging markets. And for many, that may be less than 5% of their portfolio, but given the size of institutional portfolioes, even 5% would be a large amount of money relative to the size of the impact investing market today. So I think that's a good place to start. I think in the longer term, the big unanswered question for impact investing is, can you make a credible contribution to impacts by your investments in public markets, which is clearly where the bulk of most asset owners' portfolios are. And we see a lot of thematic investing today, where people assemble portfolios and invest in companies which they think are impactful. We don't see many strategies yet which really tell a credible story about how buying shares in the secondary market, which you may hold for a short or a longer time, makes a difference to that company having impact. That may evolve over time. We want to be open-minded about it, but I think it's less clear in the market today than the contribution story is for private equity and private debt, where you have a much more of a direct relationship to the company and more clearly providing additional capital to help companies grow and expand their impact. So I think for asset owners, I think it's going to be, it's going to be a journey. It's going to start, I think, probably small allocations to private equity and debt and evolve from there. And what we hope is that the impact principles are going to be helpful to those asset owners that do want to start making allocations to impact assets by providing them a straightforward way to screen asset managers and funds to identify those which will manage their funds for impact in a disciplined way. So hopefully this will be a helpful tool for the asset owners. Now to turn to your questions about asset managers. I think there are two challenges really for asset managers today. One is establishing this credibility to attract more impact capital, and that again is where we hope the impact principles will be helpful in helping them transparently disclose and follow common approaches and how they manage for impact. And the second challenge is to find more investment opportunities and to scale up the investment opportunities to absorb the large potential demand that we see out there. So I think it's an interesting time in the market now. We are seeing larger pools of capital now being raised for impact funds. You're seeing $1 billion, $2 billion impact funds being raised, which is an order of magnitude larger than what you would have seen 2 or 3 years ago. So the challenge now is in finding the investment opportunities to deploy those larger amounts of capital. As I said earlier, I think if your focus is on achieving the SDGs, then that would drive you particularly to be looking for opportunities to deploy that capital in emerging markets. And that's where development finance institutions like ourselves come in, providing co-investment opportunities, our ability to source transactions and to manage investments in emerging markets are what make us a natural partner for the impact investors who want to gain exposure and deal flow in those markets.
Thanks. And that leads in well to another set of questions that came in, again, now and in advance, that people are really interested in how you balance or how different types of investors balance across potential impact, their return profile. You spoke to that a little bit and gave an example of being able to invest for impact without sacrificing returns. But can you just talk a little bit more about both how that looks different when you're applying an ESG strategy versus impact by the definition that you gave earlier in the webinar, how that looks different, and what are the kind of performance questions and answers on an ESG strategy and impact investing. And then also, how do different investors either co-invest with different risk return objectives or provide additional kinds of, you talked about providing additional kinds of assistance to ensure that there is positive impact outside of just the investment itself.
Okay. So now we've lost your first question after listening to the second one. It might be your first question now.
Well, coming out of questions of performance and how people are balancing the kind of impact that they're looking for and the kind of returns that they either need as different kinds of institutional investors have stakeholders that they are responsible to or are looking for, and how different kinds of investors can kind of play together to achieve greater impact, even though they may have different performance or return requirements.
Right. Yeah, good. So the first thing to say, I think, is that we want to be careful not to suggest that impact investing is somehow superior or more important or more valid than ESG investing and other forms of investing. I think different investors will take different views on what they want to have in their portfolio. And some may just want to have a portfolio with a financial objective, but they want to take care to manage ESG risks. Some may have a financial objective, but want to actually, alongside that, produce some positive ESG benefits. Then there are those who will want to go for some or all of their assets to actually managing with an impact objective. And so I think those are all valid choices for an investor to make. I think what's important is the clarity of knowing what choice you're making and therefore managing your portfolio accordingly. And so the big difference, I think, between the ESG strategies and the impact strategies comes down again to this asset selection of actually choosing where to invest and what to invest in with an impact objective, as opposed to that really being driven by potential financial returns and then trying to manage the ESG risks and opportunities along the way. I think it does drive you to a different type of asset selection. But beyond that, I think clearly there is a lot of alignment and commonality between these approaches. So, for example, one of the principles, and the impact principle, says that you should first have good ESG risk management practices. So, for us, being an impact investor, if you're following the principles, is built on a baseline of being an ESG investor. Most of the signatories to the impact principles are already signatories of the principles of responsible investment. And that may seem obvious, but actually in the early days of impact investing, there were plenty of impact funds out there which didn't have any ESG standards in place. So we do think this is an important piece of housekeeping for impact investors to put in place to make sure that they are first following good ESG standards before you go beyond that to focus on positive impact. And now I've forgotten your second question.
There was a lot bundled in there. And we're actually getting close to time. So I know there are many more questions coming in and that were submitted in advance. I know we won't have time to get fully into all of them, but would encourage everyone to send questions my way. You'll be getting an email tomorrow with the recording of this webinar and ways to get in touch. So please do follow up for questions that we haven't had a chance to get into. But may just turn to the final set of questions around kind of where do we go from here? What are some next steps? So many people were interested in kind of what's next for operationalizing the operating principles for impact investing themselves. And then also, where do you see gaps or areas to explore and to keep moving this field forward that participants on this webinar could be helpful with?
Great. So I think it's going to be very interesting over the next year. We already have over 70 institutions have adopted the principles. We expect that number to keep going up. And so all of those signatories within a year of joining and signing the principles will be publishing their first disclosure statements. I think for all of us who are interested in impact investing, this is going to be a fantastic opportunity to read all these disclosure statements and just learn a lot more about how different investors are actually managing their portfolios for impact. I think we'll learn a lot about where the areas of convergence and common approaches are, which we can build on. We'll also learn where the gaps are and where we need to do more work to make progress. So I think coming out of this first year of experience and the disclosures that we get from that will help to develop an action agenda going beyond that. But even now, we can see appetite amongst the signatories for sort of peer learning and developing common best practices. So we're starting to have phone calls and workshops for signatories, and I think there is a lot of benefit in that shared learning, and so we see that as a big benefit for being part of the group of signatories. And lastly, I think over time we will see this convergence in terms of impact metrics and impact management practices. I think there's a lot of momentum in that direction, so I expect that to continue. But just to finish, I think, coming back to the points about the Sustainable Development Goals and the huge amounts of capital in the world, I think that the endowments and the asset owners that are represented by your network really do have a key role to play in thinking about how the assets that they manage can also have a contribution to achieving the Sustainable Development Goals. And so we're always happy to talk to asset owners about how we can share what we've learned about doing this, or how we can work together.
Wonderful, thank you. So I think those themes of peer learning, continuing to evolve both the metrics and the impact that we're trying to measure, and that collaboration between asset owners who are trying to align their goals with the investing opportunities available to them, and the rest of the field that's making that possible, are all things that we're looking forward to continuing to collaborate with you on. So you have both of our websites on the screen. Please do stay in touch, send through any questions that weren't fully answered on this webinar. Keep an eye out for communication from us. Look into both becoming a signatory to the operating principles and look into membership with the Intentional Endowments Network and other peer networks to continue this conversation. And thank you all for joining today. Thank you, Neil and your team, for a very informative presentation, and thanks all for your active engagement through the webinar. And with that, we will close. Thank you all, and enjoy the rest of your day.